Hi, I'm Hetal Mehta, the Head of Economic Research here at St James's Place. So what we're here to talk about today is interest rates, how high they've got to, are they going to come down, and what you can do about the current interest rate environment. I think for the time being, higher interest rates are going to be the new normal. Central banks have obviously increased interest rates to try and tackle inflation, and they've made a lot of progress. Inflation is starting to come down, but we're not really in the kind of territory that's quite in line with what their 2% targets would dictate. So we think it's going to be a while before interest rates can start coming down, particularly in the UK, where wage inflation is quite high, and inflation, once you take out things such as energy and food prices, is also still quite high. So it's going to be a few months yet before the Bank of England can start thinking about cutting rates. I think there's a chance interest rates could go higher if there are any upside surprises to economic growth or inflation starts to pick up again. Certainly, central banks are going to be willing to at least examine the possibility of rates going up. But I think it's more likely that rates move down rather than move up from here. But we're still in that zone where it's much more a two-way bet. So it can take quite a while for the interest rate changes to feed through to the economy. By the time a central bank increases interest rates, people see that come through into higher mortgage rates, and then they start making different spending decisions on the back of that. It can take a while, maybe 12 to 18 months. And in particular, when we have a lot of people with fixed rate mortgages, it can take even longer. Someone who took out a mortgage 2 or 3 years ago won't have been affected by the higher interest rates that we've seen so far. But once they do remortgage onto higher rates, that will inevitably affect their borrowing patterns. And similarly, for people who are saving, you will see those interest rates gradually get passed on, but it's not an instantaneous effect. So it can take quite a while for policy to take effect. And in the UK, the Bank of England thinks that the interest rate pass through is only about halfway through. Yeah, so with interest rates having gone up, even if they don't move from now, there are more and more people who will need to refinance onto higher mortgage rates, or the banks haven't fully passed through all of the interest rate increases into savings rates. So banks are often quick to pass on to borrowers, but slower to pass on higher rates to savers. And that process is still going to probably take a few months to take effect. We have started to see mortgage rates edge a little bit lower, probably as banks start to anticipate that the Bank of England is finished with increasing interest rates. But there can also be a whole variety of reasons why banks may feel that there's not much point pushing up mortgage rates any higher from here. Remember, it's that balance of supply and demand. There'll also be a bit of competition between lenders as well. So we are starting to see mortgage rates edge down a bit. We still think that there are some really good opportunities in the stock market, certainly smaller UK companies. And I think there's also some benefit in emerging market equities as well. So just because cash rates are high doesn't mean that other investments are to be completely ignored. And obviously for some people, in terms of their risk profile, they may find investing in keeping their money in cash a good idea. But remember, cash rates aren't going to stay at these levels for very long. So you want to maybe think about locking in a good return for a longer period if that's something that's possible. Thanks very much for listening. You've heard me talk about interest rates, where we think they might be going, and what the other opportunities might be. I'm Hetal Mehta, Head of Economic Research at St James's Place.